At the start of the year, the UK Prime Minister announced 5 key priorities that he and his government wanted to achieve in 2023. 2 of those being around the state of public finances and the economy. And they are as follows. 1. To halve inflation this year to ease the cost of living and give people financial security. And secondly, to grow the economy, creating better paid jobs and opportunity right across the country. And now we've entered into the second half of this year, it doesn't exactly look like those priorities are exactly being fulfilled. Unfortunately, it appears like we're facing into yet another year of false hopes and promises from the UK government, and unfortunately will only ever result in ever more financial pain for us, the UK public. The data that I found for today's video is truly shocking. But not only do I want to focus on perhaps the bad points, but I also want to potentially share with you guys some options as to how you could potentially alleviate some of the pressures and stresses that come with the current cost of living crisis a little bit later on in the video, so be sure to stick around for that. So let's address the first priority from the UK government, which is to halve the inflation rate. Right now, UK CPI stands at 8.7%. which is down from 10.1% at January this year. Now, in order to facilitate this decline in the inflation rate, the Bank of England have invoked a monetary policy which involves the hiking of interest rates. As a result, we've gone from interest rates of 0.1% right the way up to 5% as at the end of June. Now, despite interest rates being the catalyst, if you like, for lower inflation, it's not exactly done its job, or at least it's not done its job as well as the Bank of England have forecasted, based on the data that they've provided. And one of the reasons for this is thanks to big corporation profiteering.
I like money.
It's something that's been spoken about quite a lot in the news lately, but this very much feels like a case of the rich getting richer and the poor getting poorer. Data provided by UK Parliament actually shows that some of the biggest contributors to the inflation rate are actually the increase in food and energy prices. And whilst we've all been fed the narrative that it's all Russia's fault and Vladimir Putin's fault for the rise in energy prices, actually energy prices right now on the wholesale market are actually pretty comparable to what they were pre-pandemic. Yet our gas and electricity bills don't exactly seem to be coming down. To show you the charts, the wholesale electricity market is trending downwards and is back at multi-year lows. So with gas and electricity prices coming down, it certainly does raise questions when you've got people like the CEO of Centrica, which is the company that owns British Gas, coming out and saying that he expects that actually energy prices will remain high for the foreseeable future. Perhaps it might be something to do with the fact that he's had a £3.6 million bonus this year, along with deciding to reinstate dividends for their shareholders thanks to the record profits that they've achieved. Now, I don't know about you guys, but that doesn't feel quite right from where I'm sitting, or at least my interpretation of what's going on. And that's despite the fact that it's a regulated industry. Albeit the financial services industry is regulated too, and there's plenty of problems in that space that we've seen in the recent decades. But look, the energy companies aren't the only ones at it, because the supermarkets are at it too. There was recently an investigation from the Competition or Markets Authority into the pump prices that me and you guys are paying at supermarkets. And that was following concerns that wholesale prices weren't actually being passed on to consumers. And you actually can't believe this, but profit margins on fuel for supermarkets have actually increased by 13p a litre from January to May this year. And that's despite the fact that petrol prices have actually been falling. Yet supermarkets appear to be capitalising on increasing their overall profit margins per litre of fuel that you fill your car up with, because it certainly feels like for you as a consumer that it's more cheaper now to fill up your car than it was in the past. And whilst we're on the topic of supermarkets, what's even more painful is that food price inflation is actually up at 18.3%. And whilst that's not necessarily down to supermarket profiteering, actually many of the supermarkets have seen a decline in their overall profits in the last couple of years, it is quite shocking that they've actually had the nerve to try and cream some profits at the pump. So what is the impact of this, and what are the other factors that are actually contributing to the squeeze on public finances? Well, in terms of overall impact, it's looking pretty dire. 1/3 of Brits are now living paycheck to paycheck, and quite literally struggling to make ends meet. The combined net flow of household deposits with banks and building societies last month was actually negative £3.8 billion. So people are actively spending more now, and I don't suspect that's spending on nice things in life. I suspect people are drawing down on their savings in order to be able to afford their mortgage and their bills. But it gets even worse, because there was some data that was recently published by the National Institute of Economic and Social Research, which states that 1.2 million households, which is about 4%, will run out of savings this year as a result of higher mortgage repayments. That takes the total number of insolvent households, which is absolutely shocking, to around 7.8 million people. That's about 28%. Those 7.8 million households are people with families and children that need to be fed. To be facing into a situation where 28% of households could become insolvent is absolutely diabolical. Which leads me on to the UK government's second priority, which is to grow the economy, creating better jobs and opportunity right across the country. However, the UK economy unfortunately remains the slowest growing economy across the G7 countries, with the economy actually being 0.5% smaller than pre-pandemic levels. So we're certainly falling behind from an economic growth standpoint compared to our global counterparts. And as a result, with an economy that's not exactly booming, we're not exactly creating better paid jobs either. The numbers that we're being presented with is actually that wages are up 6.5% this year. But actually, when we look at real wages and compare them against inflation, actually real income is down about 2%. And actually that's a comparison just on those publicized numbers. I bet some of you guys watching this video probably haven't even had a 6.5% pay rise this year. And if that's you, well, your real income will be somewhat more worse than the figures that are being published. The reality is, even if your employer did kind of give you a 6.5% pay rise this year, the reality is one of the biggest household expenses that we all have is our mortgage repayments. And they're up about 60% when compared to the interest rates that we had in most recent history. And on top of that, the average monthly energy costs are up about 214% from pre-pandemic levels. So look, it doesn't take a mathematician to work out that the squeeze on public finances is absolutely insane. And I really don't think that the UK government have any kind of idea at the scope of the problems being faced into. I mean, they've even been bringing in bank executives to Downing Street to discuss the mortgage crisis, which is probably a sign that you know things are bad. And from those conversations, here's what they agreed.
Well, as I said, we agreed some very important things for people who are worried about their rates going up, not just the people who are in an extreme situation, but the most significant thing is that they can pick up the phone to their bank or their mortgage lender and talk about their situation without any worry that it will impact their credit score. And if they decide to make their payments easier by extending the period of their mortgage or by going to an interest-only package, they can go back to their original package without any questions asked, without any impact on their credit score within 6 months.
So in summary, there's not really any more options on the table now than perhaps what we had previously. And actually, none of those options are financially beneficial for us as customers. If you do decide to go on an interest-only mortgage, well, that's fine. It will lower your monthly mortgage payments, but you'll never own the house that you live in. And therefore, you might as well just go and rent somewhere instead and let a landlord deal with all of the issues of home ownership. The other proposed solution was to extend the term of your mortgage, but that massively increases the total amount that you will repay over the course of 25, 30, 35 or 40 years. And yes, some banks are really offering up to a 40-year mortgage term, at which point I'd probably even question whether it's even worthwhile to pay the bank back for such a long period of time in order to own the house that you live in. The only reason people buy houses is because they typically go up in value over time, and they're typically an inflationary beating asset class. But with house prices so high and interest rates so high, it certainly begs the question as to whether it's worthwhile actually having a mortgage for that long a period of time. Because if the combined impact of high interest rates and inflation is more than the future value of the property 40 years from now, there is literally no point buying a house. To give you guys context of how this works in practice, if you had a £200,000 mortgage at a 6% rate of interest over 25 years, which is perhaps more of the normal term of a mortgage, then you'd repay £386,000 with repayments of £1,289 per month. But if you increase that mortgage term with everything else remaining the same to 40 years, you would actually repay £528,000. That's a reduction, or a saving if you like, of £150 a month on your repayments. But over the 40-year period, it will actually cost you £142,000 more, which is absolutely insane. And I actually can't believe that it's a valid solution for some people that are in financial difficulty. So the reality is the pinch on public finances really aren't going to get any easier. And the government or the central bank certainly aren't going to be coming to the rescue anytime soon. This is, as I see it right now, people either sinking or swimming financially. And unfortunately, those at the lower end of the income spectrum will be the ones that sink. The government are pretty much burying their heads in the sand after printing billions of pounds worth during their quantitative easing programs during COVID, along with all of the impacts thanks to lockdowns, which are now we're seeing the consequences of in the economy. So that unfortunately leaves us all with one option only, especially for those who are struggling the most, and that's to look after our own self-interest by bettering our financial positions. Because as I'm learning in life, the only person that you can 100% rely on 100% of the time is yourself. So being in control of your own financial future is no longer an option. It's an absolute necessity. So to help bring that to life for you guys, I've actually created another video which is around how the normal person can actually become rich. So be sure to click on that video now in order to improve your own finances before things get a hell of a lot worse.